Welcome to Financial Accounting Made Simple. This is lesson 1, Introduction to Financial Accounting, and you can get the accompanying book on the link shown on your screen. To begin with, we'll talk about the definition of financial accounting and its distinction with management accounting. We'll then talk about the different types of business entity, the major financial statements and objectives of these financial statements, the elements of financial statements, qualitative characteristics, accounting concepts and assumptions, and the users of financial statements. So accounting is the recording, summarizing, analyzing, and communicating of financial information to help users make informed financial decisions. So you can see from there that it's more than just reporting information. You have to record it, you summarize and convert data into information in order to help users of financial information make informed financial decisions. There are several users of financial statements, including shareholders who want to see how the business is performing and whether they should disinvest or invest in the organization, suppliers who want to see whether the business has the ability to pay its debt and whether they should provide credit or not to the business, management who are involved in the overall performance of the business and what they can do in order to improve that performance, employees who want to use financial information for bargaining for their benefits, lenders who want to see whether the business is capable of paying them and whether they should lend to the business or not, government who wants to look at regulatory aspects such as the taxes that a company needs to pay, and customers, especially in some sectors like the construction and consultancy sector, where customers want to see the company's ability or the business's ability to pay or to deliver its services if a project is very big. The types of entities that we will normally account for will be either non-profit seeking organization or profit-seeking organizations. Most of the discussions we'll have in the course are on profit-seeking organizations. There are 3 categories of profit-seeking organizations that will be relevant to this discussion. The first one is sole proprietors. A sole proprietorship is a business owned by one person. This person may employ other people to help them run the business. A partnership is a business owned by 2 or more people, and these people may employ other people to help them run the business. A company is also a business in most jurisdictions that is owned by at least 2 people, but what distinguishes it from a partnership is that a company, unlike a partnership or sole proprietor, has limited liability. Limited liability means that if the company fails to pay off its debt, the debt or creditors of a business cannot go and claim money from the owners of a business. So the liabilities are limited to the amounts the owners have invested in the business. Unlike a company in a partnership or a sole proprietorship, if you invest money and the business fails to pay off its debt, the debt holders can come to the shareholders and claim the monies from the sole proprietors or the partners, whereas in a company they cannot claim extra money from the sole proprietors, from the company shareholders. When preparing financial statements, there are several objectives, but the key ones are that financial information aims to show the financial performance of a business, it aims to show the changes in financial performance, and it aims to show the financial position of the business. In that regard, a company organization is likely to prepare a statement of profit or loss and other comprehensive income, a statement of changes in equity, a statement of cash flows, and I did not include this one, but a statement of financial position. By the time you are done doing this course, you must know how to prepare each and every one of those. There are several elements of financial statements, and these include assets, liabilities, equity, income, and expenses. Assets are the resources controlled by the entity as a result of past events and which are expected to result in inflow of resources embodying economic benefits. To get what this definition means, think about something a business owns, like a vehicle. A vehicle is controlled by the business. It is expected to result in inflow of economic benefits. Consequently, it is an asset. A liability is an entity's or a business's present obligation arising out of past events and which is settlement of which is expected to result in outflow of resources embodying economic benefits. An example of a liability is a loan, a long-term loan, for example. It's a present obligation. The business has to pay back that obligation, and once they settle the obligation, it will result in outflow of resources, and therefore that's an example of a liability. Equity is the owner's residue interest in the assets of a business less its liabilities. So equity is usually found by subtracting assets from liabilities. If you think about that, that is why we have the accounting equation at the bottom there. The accounting equation says assets equals to equity plus liabilities, so that if you then change the subject of the formula, equity equals to assets minus liabilities. Income represents the increase in resources other than that which relates to equity participants. So think about sales revenue. sales revenue results in increase of cash in the business, but this cash is not coming from equity participants, and therefore it is income. Think also about capital. If the owners of a business introduce capital, that's an increase in resources, but it is coming from equity participants, and so it is not income. Expenses, similar to income, is a decrease in resources other than that which relates to equity participants. So for instance, if you're paying for rent for the business, or you're paying for electricity, you have a decrease in resources, you have a decrease in cash, but this decrease in resources is not because of equity participants, and therefore it is an expense. You could distinguish this from dividends. Dividends are payments to the owners of a business, and while they are a decrease in resources in the business, they relate to equity participants, and therefore they are equity. You might want to note that each of these elements can be further broken down into different categories. So for instance, assets can be broken down into non-current assets, which are assets that are used for a long term in the business, usually a period of more than 1 year or one accounting period, whereas there are current assets which will be utilized within a period of less than one accounting period, which is usually 1 year. There are also liabilities, which can be broken down into non-current liabilities or long-term liabilities and current liabilities. We'll talk about the different categories of liabilities and assets as we discuss other chapters. When preparing financial statements, we make several assumptions, but the two key assumptions are going concern and accruals. Going concern is the assumption that the business will continue in existence for the foreseeable future, whereas accruals is the assumption that expenses in a particular period are matched with income in that particular period, rather than when cash changes hands. You could also have business in accounting concepts such as the business entity concept, which presumes that the business and the owners of a business are separate individuals. Therefore, when money comes into the business from the owners, it is supposed to be accounted for as capital, and when money goes out of the business to the owners, it's supposed to be accounted for as either drawings or dividends. You also have the consistency concept, which is the idea that items have to be, or policies, accounting policies have to be applied in the same way from year to year, and if there's a change, it has to be justified, properly justified. Duality is the concept that, or assumption that, each accounting transaction affects two sides or two separate accounts. So for instance, if you buy goods for resale, you're going to have an increase in inventory, so, and there'll be a decrease in cash. So the same transaction is going to affect two accounts, which is cash and inventory or stock. Materiality concept is the assumption that you only show significant amounts in the financial statements. You only show amounts that are useful for economic decision making. So for instance, in a big company that reports in millions of dollars, showing the amount that was spent on buying staples for stapling paper is maybe irrelevant for economic decision making, because it will be so tiny in the financial statements. You would rather maybe group it up with other items and show it as stationary for better economic decision making. Materiality differs from company to company, because if you move from that multinational company with millions of dollars and go to a company that reports in hundreds of dollars, just the purchase of staples might be significant for economic decision making, and those may be shown individually. The monetary unit concept is the idea that you report financial statements using monetary value. So when you talk about accounting, you will be seeing that you'll be reporting financial statements using finances, and that is why you have basis of measurement when you're accounting for different things. Financial information needs to be accurate, it has to be quantitatively justifiable, but it also requires qualitative characteristics, and there are two main groups of qualitative characteristics of financial statements. These are fundamental qualitative characteristics and enhancing qualitative characteristics. The fundamental qualitative characteristics include faithful representation and relevance. This means that when you present financial information, it has to be presented in a faithful manner. It has to show a true and fair view of what's happening in the business. Then it also has to be relevant. You don't provide information that is irrelevant, and that is why we talked about materiality. Further, the financial information has to be comparable from year to year for the same company, and from company to company in the same industry. It has to be understandable, meaning that it has to be simplified, but you do not simplify it so much so that it loses meaning. It has to be timely, because if you prepare financial information too late, it may not be useful for economic decision for some users. It has to be verifiable, which means if you bring someone like an auditor who has access to the entire organization and ask them to verify or to check the way you've prepared the financial statements, they should be able to confirm that financial statements have been prepared in a true and fair manner. If they are not able to verify because of lack of information or anything in those lines, then the financial information is not verifiable and it does not have good qualitative characteristics. Finally, financial accounting needs to be distinguished from management accounting. There are several qualities or characteristics that you can use to distinguish between financial and management accounting. Firstly, financial accounting has an external focus because it provides information to external stakeholders, whereas management accounting provides information to internal stakeholders. Financial accounting is usually historical in that it's providing information about what has already happened within the organization, whereas management accounting is futuristic in that it provides information about what's going to happen, such as budgets or projections and the like. Financial information is usually summarized, whereas management accounting information is not as summarized. It's detailed to provide internal stakeholders more information. Financial accounting information is required legally, whereas, especially for listed companies, whereas management accounting information is required by management and not from a legal point of view. Financial accounting information is provided in standard format, so there are international accounting standards that guide on how financial information should be presented, whereas management accounting information is not in standard format. Management can decide as and when the formats that they want financial information to be presented in. So this is an overview of the introduction to financial accounting, and we'll see you in the next chapter. Please do check out the examples in the book and do further reading by checking the link as shown here.